Welcome to the Deep Dive. We're here to give you that essential shortcut, helping you navigate some pretty complex information and hopefully come out the other side incredibly well informed. Today, we are definitely not just dipping our toes in. We're plunging deep, really deep into the fascinating, sometimes counterintuitive world of financial markets. And we're doing it through the lens of, well, one of its most legendary figures.
That's absolutely right. Our main job here today, our mission for this deep dive, is to really meticulously unravel the latest quarterly disclosure from Warren Buffett's Berkshire Hathaway. We're talking about the Form 13F filing. Always much anticipated, always heavily scrutinized. It just came out this week. And look, it's not just some dry document. It's actually a rare, you could say invaluable window into the strategic mind, the recent capital decisions of a real market titan.
Okay, so our objective is pretty clear then. We're going to systematically unpack the key revelations, the big takeaways from this filing. But we want to go beyond just what they bought or sold. We really aim to get a grasp on the why behind Berkshire's big moves and maybe spot some underlying patterns that could offer, really valuable insights for any curious investor or, frankly, anyone just keen to understand how long-term wealth gets built. So for you listening, the core question driving us is, what actionable wisdom can we actually pull from the Oracle of Omaha's latest plays?
And to do that, we've carefully synthesized quite a stack of source material. We've got the official SEC filings, the raw data, you could say. But we've also got insightful financial news analysis to help put it all in context, interpret the numbers. It's a pretty comprehensive approach designed to make sure this deep dive gives you a nuanced, really complete picture. So let's start by maybe demystifying the actual document itself.
Right. So for those of you who regularly follow the big market players, the quarterly rhythm of the 13F, it's probably familiar territory.
Right.
But maybe for anyone new to deciphering, let's call them the tea leaves of institutional investing, what exactly is a 13F filing? And why does Berkshire Hathaway's version always seem to generate such an intense flurry of analysis every single time it lands?
Yeah, it's a really fundamental piece of the market puzzle. So a 13F filing, it's basically a mandatory quarterly report. It's strictly required by the U.S. Securities and Exchange Commission, the SEC, right? And it applies to any institutional investment manager overseeing more than $100 million in U.S.-listed common stocks. You can think of it almost like a transparent inventory list for the biggest players in the game. It's how the public and regulators, too, get a snapshot of what these titans are holding in specifically their domestic equity portfolios. And for Berkshire Hathaway, given their staggering size and influence, its 13F is arguably the most watched, the most dissected filing out there.
Okay, and this specific one, the one we're focused on, it came out Thursday, August 14th, 2025. And it details Berkshire's holdings as of June 30th. So yeah, by definition, it's backward-looking. It's a snapshot from, over a month and a half ago? So some people might argue, look, if it's already old news, how valuable can it really be for making decisions now? What's your take on that? It seems like a common point of confusion.
That's an excellent question, and it really gets to a common misunderstanding about the 13F's actual value. You're absolutely right. It doesn't give you real-time trades. You won't see what they bought yesterday or 5 minutes ago. It also doesn't show short positions or what they own in, say, European or Asian stocks. But its value, its immense value, lies elsewhere. It's less about being a real-time GPS for individual trades and much more about deciphering let's call it the strategic roadmap of a master investor. It's like an invaluable X-ray into their long-term strategic shifts, their new high-conviction ideas. It reveals where they see enduring value, not just, short-term market noise. And for a company like Berkshire, famous for holding things for years, sometimes decades, this historical data gives you a really profound glimpse into how their thinking is evolving, their thesis on the economy, on specific industries.
Okay. So it's less about trying to copycat their trades, which, like you said, would be pointless anyway because of the delay, and more about uncovering that strategic blueprint. It's kind of like studying the moves of a chess grandmaster. You're not trying to predict their next immediate move, but you want to understand the long game, the overall strategy, how they position their pieces for the future.
Precisely. That's the core insight here. This historical data is invaluable for seeing the broad patterns, the strategic intent. You're not really trying to copy trades. If you tried to replicate Berkshire's buys right after the filing, you'd almost certainly be buying at higher prices than they did. You'd miss their entry point. What you really gain is insight into their thought process, their macro views on the U.S., maybe the global economy, where they see long-term value building up. So this deep dive, it isn't about giving you a stock tip. It's about offering a mental framework, really, a way of thinking about markets that kind of mirrors the disciplined approach of, one of the greatest investors ever. It's a lesson in patience, conviction, qualities that are often, pretty scarce in today's fast-paced markets.
And that strategic insight, even with the built-in delay, it seems to have this almost immediate kind of magical impact on market sentiment the second it goes public. And it's really something to watch.
It absolutely is, and it's a fascinating case study in market psychology, really. The very moment this 13F filing hit the news wires, we saw an immediate and, frankly, pretty predictable market reaction. Stocks that were newly revealed as Berkshire purchases, companies across different sectors like United Health, Nucor, D.R. Horton, Lennar, Lamar Advertising, Allegiance, they all saw these significant surges, either late Thursday or dramatically in after-hours trading. It's such a consistent phenomenon, it actually has its own name.
Yeah, people call it the Buffett bump, right? Or getting the Buffett seal of approval.
Mm-hmm.
It's almost like a stock gets knighted or something.
Yeah.
Suddenly, the whole market just rushes in to get a piece. But what's really driving that instant surge? Is it just, herd mentality, FOMO, fear of missing out? Or is there maybe a more rational, justifiable reason behind it? I mean, Berkshire has armies of analysts, incredible access, and amazing track record over decades.
You've hit the nail on the head there. It's undeniably a mix of both things. On one side, yeah, there's definitely an element of psychological contagion. That fear of missing out is real. People see Buffett's name, Berkshire's name attached to a stock, and they jumped in, partly because they just intrinsically trust his judgment. They assume he knows something they don't or sees something they don't. It's almost an act of faith for a lot of investors. But then, on the other hand, there's a very rational basis for that trust. Berkshire Hathaway doesn't just make casual bets. They do incredibly extensive due diligence. They often talk directly with management teams. They have deep industry knowledge. And crucially, they operate with this super long-term perspective that most individual investors, maybe even most institutions, just can't replicate. So for a big chunk of the market, seeing a Berkshire purchase acts like a powerful signal. It's an indication that these stocks have already passed this incredibly rigorous fundamental test. The real takeaway from the Buffett bump isn't just about a stock price popping. It's actually a profound lesson in market conviction. When arguably the world's most disciplined investor makes a move, it signals that their intense long-term homework has already been done, and that reduces the perceived risk for everyone else. It really highlights how investor trust, built up over decades, can itself be a market-moving force, sometimes almost separate from the immediate fundamentals. Now, this dynamic, it can create opportunities for nimble traders who understand the short-term news flow, sure, but it can also cause significant short-term volatility for folks just chasing the headlines. It's a powerful influence, shaping sentiment in very real, immediate ways, sometimes completely independent of what the company itself is doing.
Right. And speaking of those real moves, that intense focus on specific companies brings us right to what's inside the filing. Let's really start peeling back the layers now and dive into some of the specific businesses that Berkshire Hathaway, have put their considerable weight behind, because honestly, some of these are quite surprising. Okay, let's kick off with what a lot of people are calling the most intriguing move, maybe even the most perplexing one in this whole filing. A significant new play in healthcare, specifically with United Health Group. Ticker UNH. Okay, let's unpack this. Why would Buffett, a guy who famously called healthcare costs a tapeworm on the U.S. economy, and remember, his own big healthcare venture, Haven with Diamond and Bezos, it fizzled out. Why would he now make such a big bet on a company like UNH? Especially when facing so many serious headwinds right now. It feels almost contradictory.
This is truly where the deep dive gets fascinating. You're right. It reveals a potential shift, or maybe more likely, a really strong contrarian perspective. So Berkshire established this substantial new position, 5.04 million United Health shares, valued around $1.57 billion as of June 30th. Now, it's worth remembering Buffett has owned UNH before, a smaller stake, about 1.18 million shares between 2006 and 2009. But he sold it all by 2010, so it's not totally out of the blue, but it is a significant re-entry after a long time away. What's really striking, though, is the initial paper performance for Berkshire here. Their average purchase price was apparently $311.97, but UNH closed at just $271.49 right before the disclosure came out on Thursday. That means Berkshire was initially down on paper about 13% on this investment. Ouch! But then, like you said earlier, the Buffett effect kicked right in. UNH shares soared like 8.2% to 8.5% in after-hours trading, hitting $293.75, and then they climbed even further overnight to $307.16. Basically wiped out a big chunk of that initial paper loss almost instantly.
Wow. So he buys into a company that's been tanking, and then the market finds out he bought it, and it validates his position almost immediately. But let's be really clear about what United Health has been dealing with. The stock was down, 46% this year alone, leading up to Thursday? They're grappling with soaring medical costs. They've slashed their profit forecast, expecting billions in extra costs. On top of that, there's a U.S. Department of Justice probe into their billing practices. They just dealt with a major cyber attack recently. And just tragically, a former top executive was shot and killed last December. I mean, it's a serious, multifaceted storm they're in, not just some minor turbulence.
You've laid out those headwinds perfectly. And your point about Buffett's history, his past comments, is absolutely crucial. He did famously call high healthcare costs a tapeworm on economic growth, a systemic problem. And he, along with Jamie Dimon from JP Morgan and Jeff Bezos from Amazon, tried to tackle it with their joint venture, Haven. That was a really ambitious project aimed at improving employee healthcare, cutting costs. But ultimately, it shut down in 2021 after just 3 years. Didn't really get off the ground. So yeah, on the surface, seeing him re-enter this very sector, and specifically into a company facing such intense specific challenges, it does look genuinely perplexing at first glance. However, this UNH bet, despite that initial 13% paper loss and the whole list of negative headlines, it looks like a classic contrarian play, maybe one of the most visible ones from Berkshire in a while. The key insight here, I think, is that true value investors, the really disciplined ones, they don't necessarily shy away from companies in rough waters. Sometimes they actively seek them out, especially when temporary problems create what they see as an overreaction in the market, depressing the price of what's otherwise an indispensable high-quality business. What's fascinating here is the timing and this potential long-term strategic view that seems to be overriding the short-term pain. So why do it? Well, one major reason could simply be deep value. Berkshire might see UNH as a fantastic opportunity at these depressed prices. Despite the current struggles, United Health Group is an absolute giant. It's a critical piece of the entire American healthcare infrastructure. You could almost argue it's too central to fail, in a way, and it likely still possesses significant pricing power and market share that will probably endure long term. So maybe Buffett and his team believe the market has just excessively punished UNH for these recent difficulties, and they see substantial upside once these issues are navigated or, eventually resolved. It could also suggest a belief that UNH, despite all its problems, is so deeply embedded, so essential to any future healthcare solution in the U.S., regardless of politics or policy changes, that it's simply too vital to the country's health system to stay undervalued for long. Or, maybe simpler, it could just be a profound vote of confidence in UNH's very experienced management team, their proven ability to navigate complex challenges over the long haul. Look, this isn't your typical Buffett bet on a company sailing smoothly. It's a high-conviction bet on a hugely important company that's currently in a storm. And that's often where the biggest potential returns are found, right? It really shows a willingness to wade into controversy when the perceived value is compelling enough.
Okay, that makes sense. A bold contrarian move. So from that bet in healthcare, where maybe the market was too pessimistic, let's pivot now to a different kind of foundational investment, the housing market. Here, Berkshire's confidence seems, well, much more straightforward, almost a classic bet on America's long-term growth.
Indeed. The housing sector, that feels much more like a classic, straightforward vote of confidence. Still very significant, though. So Berkshire revealed a new stake, 1.49 million shares, in Homebuilder D.R. Horton. That was valued at about $191.5 million as of June 30th. But even more dramatically, their existing stake in Lennar, it was massively increased. They went from just about 152,000 shares at the end of March to a whopping 7.23 million shares by June 30th. That valued the stake at almost $800 million. Huge increase. And predictably, both DHI and LEN got that Buffett bump after hours. DHI up about 2.5%, LEN up 3.7%.
Right. And we know these home builder stocks have generally been doing better lately, especially as mortgage rates have started to ease off a bit, right? Particularly after that weaker than expected July jobs report, which maybe hinted the Fed might not be quite so aggressive going forward. So connecting those dots, does this much bigger bet on housing signal a really bullish view on the market's resilience? Or maybe even a strong belief in a coming recovery? And what makes these two builders, D.R. Horton and Lennar, so attractive right now, do you think?
It's a very astute connection, and I think the answer is almost certainly yes. If you connect this to the bigger picture, this looks like a clear, large-scale macro bet on the underlying strength of the U.S. economy, and specifically on the absolutely foundational industry of home building. The timing, coinciding with those slightly softer mortgage rates, probably not a coincidence. Lower rates generally boost buyer demand, makes homes more affordable, and that directly helps the builders. But I think it's more than just rates. This move strongly suggests Berkshire believes the worst of the recent housing slump, which was driven by those rapid rate hikes and all the supply chain chaos, is either behind us. Or maybe that These specific companies, Horton and Lennar, are just exceptionally well positioned to navigate whatever turbulence is left and really benefit from some powerful long-term demographic trends. What's really compelling about D.R. Horton and Lennar is their sheer scale and efficiency. These are two of the biggest home builders in the entire country. That gives them significant advantages: access to land, better supply chain deals, the ability to build at scale. They're also pretty good at adapting their products to meet demand, focusing on maybe more entry-level homes when rates are high or diversifying when conditions improve. This feels like a classic Buffett play on a fundamental, necessary industry. It's essential. It could be a long-term bet on demographics. The U.S. population is still growing. Millennials and Gen Z are entering prime home buying years. Eventually, they'll need places to live. It also probably suggests a belief that the basic supply-demand imbalance in housing, especially for affordable homes, is going to continue driving the sector for years to come. It's a very patient, very long-term wager on a core American need.
Yeah, it's interesting to see them doubling down on such a core American industry, betting on those fundamentals. But the filing also showed some other intriguing new positions and increases. It showcases a broader, almost eclectic mix of interests beyond just these big macro themes. ###TAC-C. Other notable newcomers and increased stakes. And here's where the portfolio really starts showing its diverse character. Beyond those major plays in healthcare and housing, Berkshire made several other notable moves. They started a new position in Nucor, the big steel producer. A substantial stake, too. 6.6 million shares, worth about $857 million. And here's a little detail. Berkshire's average purchase price was $129 to $155. So that one's already been a winner for them, right? Nucor jumped 7.7% after hours to $155.50, and apparently it even broke through a key buy point around $147.50 from what chart watchers call a cup with handle base. That often signals a bullish breakout for technical traders. It's also worth noting this was likely one of those confidential purchases we talked about, a tactic we definitely need to dig into more.
Absolutely. Then you've got Lamar Advertising. That's a new pickup for Berkshire. It also saw a nice little bump after the disclosure. Now, this isn't just any ad company. Lamar specializes in outdoor advertising. Think billboards, right? It's a business model that's actually known for pretty high margins, relatively low upkeep costs once the billboards are up, and kind of sticky revenue from advertisers who want that consistent public visibility. It's a bit of a niche, but one with predictable cash flows. And then there's Allegion, another new investment. They're a global provider of security products, stuff like electronic locks, access control systems. This kind of points to a recurring theme you see in Berkshire's portfolio. Investing in essential businesses, often industrial or infrastructure related, companies with durable competitive advantages.
And it wasn't just brand new names either. They also boosted some existing positions that have done really well for them. Heiko, the aerospace supplier, they added another 11% to their stake, about 132,524 shares. That position was started back in Q2 2024, and it's apparently been a consistent winner for Berkshire. It boasts a really impressive 98 IBD composite rating that's out of 99. And for anyone unfamiliar, that score combines technical strength with fundamental factors like earnings and sales growth. Basically signals a top quality stock. The filing noted it had pulled back near its 50-day moving average, maybe signaling an early entry chance for Berkshire to add more.
Correct. We also saw them add a bit more to Chevron, about 2.9% or 3.45 million shares added to that energy giant. And remember that Chevron position was famously disclosed late back in 2020 after they'd asked for that confidential treatment. So continuing to invest in Chevron really underscores Berkshire's conviction in the energy sector. They clearly see it as vital, often maybe undervalued, part of the global economy, providing essential resources. And then small increases, but still notable, in consumer staples like Constellation Brands, the drinks maker, and Domino's Pizza. These additions kind of fit that consistent theme. Investing in businesses, providing essential goods and services, often with strong brands, predictable demand, even when the economy gets shaky.
Okay, so if we look at this whole basket, it seems pretty diverse, right? Steel, billboards, security systems, aerospace parts, alongside the big bets on housing and healthcare. What do these seemingly different new and increased stakes really tell us about Berkshire's current strategy? Is there a common thread connecting them all?
Yeah. You've identified a really critical point about the Berkshire portfolio. On the surface, it looks diverse, almost scattered. But if you dig a bit deeper, you see these consistent threads that line up perfectly with Buffett's long-standing philosophy. These additions, Nucor, yeah, it's cyclical, but it's an absolutely essential materials company. Lamar Advertising, it's capital light, throws off cash, dominates outdoor media. Allegion provides critical security infrastructure. They all show this continued focus on specific, often industrial or specialized companies, as well as those fundamental consumer staples. The Nucor and Heiko editions, for instance, they point to specific views on essential materials and specialized industries, especially in areas with high barriers to entry, like aerospace. Heiko's amazing IBD rating, that tells you it's a company with strong fundamentals and technical momentum. It's objectively a high-quality growth story. What they all tend to share is this common characteristic of having strong competitive advantages, what Buffett famously calls a moat. They operate in niches where they have pricing power or provide essential services or have these durable business models that just generate consistent cash flow. It really signifies that Berkshire isn't just making giant sweeping macro bets. They're also very selectively adding to or starting positions in high quality specialized businesses that show resilience and long-term value, even if they aren't, the headline grabbing tech stocks all the time. It's really a testament to their disciplined, patient approach, finding value wherever it might be hiding.
Okay, so we've covered a lot about what Buffett and Berkshire have been buying, accumulating. Now let's flip the coin. Let's look at the other side of the ledger, what they've been selling, or at least strategically trimming back. And the biggest name here is one of his most famous, most successful investments ever. Well, let's start with what has been, for ages it feels like, Berkshire's crown jewel, Apple, ticker AAPL. The filing shows Berkshire trimmed its Apple stake down to 280 million shares at the end of Q2. That's down from 300 million at the end of Q1. Now, putting that in context, that's a huge reduction, more than two-thirds gone since Q3 2023 when they held, a staggering 905 million shares. Apparently, these are Berkshire's first Apple sales since the third quarter of 2024. Now, despite this big, consistent reduction, Apple still remains Berkshire's single largest stock holding, by a lot. Interestingly, Apple shares didn't really react much after hours to this news. As still number one, but this is a remarkably significant, consistent pattern of selling. Is this just simple profit taking from an unbelievably successful investment? Is it strategic rebalancing?
Or could it be maybe a subtle but profound shift in how they view mega-cap tech valuations right now?
That's a profoundly important question, you're right. And it definitely invites a deeper look than just saying, ooh, they're taking profits. I mean, taking profits from an incredibly successful investment like Apple, that's certainly part of the equation. The returns have been phenomenal for Berkshire. But the sheer scale of this reduction, going from over 900 million shares down to 280 million in just a few quarters, that suggests something more strategic is going on than just a minor trim. This is a significant reallocation of capital. It definitely could be a strategic rebalancing act, like you said, taking some chips off the table from this huge winner to deploy that cash elsewhere, maybe into some of those new positions we just talked about, housing, Nucor, or maybe just adding to that enormous cash pile. It could also signal a subtle yet significant shift in their outlook on those mega cap tech valuations. Look, Apple is undeniably a phenomenal company, unparalleled ecosystem, right? But its valuation has soared, and maybe Berkshire just sees less compelling upside potential at these current levels. Or, crucially, maybe they see greater opportunities in other sectors now, sectors that are less crowded, maybe align more closely with traditional value principles. It doesn't signal a full retreat from Apple, like you said. It's still their dominant holding, but it very clearly indicates a more cautious stance regarding how concentrated it is in their portfolio. It suggests a desire to maybe reduce exposure to what became such an outsized position for so many years. Perhaps it's a risk management move given market uncertainties, or maybe it's just freeing up capital for future potentially massive opportunities that aren't even public yet.
Right. And it wasn't just Apple, the tech behemoth, that saw some trimming. Another major long-held position, this one in the financial sector, also got reduced. Hashtag B, reducing Bank of America BAC.
That's correct. The filing shows Buffett sold roughly 4% of his remaining Bank of America stake. So that stood at about 605.27 million shares on June 30th. Down from 631.57 million back on March 31st.
Okay, so similar to Apple, it's a definite trim, not a complete exit, but it does follow that noticeable pattern of selling in major long-held positions. What does this specific reduction in Bank of America tell us? Is it just a minor portfolio tweak, or does it maybe hint at a broader strategic rethink about the financial sector, especially given all the headwinds banks have faced lately?
Yeah, it seems consistent with a generally cautious approach they're taking. This reduction in Bank of America, even though it seems small at just 4%, it does align with that trend of kind of fine-tuning exposure across their biggest holdings. It could just be a minor portfolio adjustment, maybe related to optimizing sector weights, or it could reflect a subtle move to reduce exposure to the broader financial sector. I mean, the financial sector, as you alluded to, it's faced its own unique set of challenges recently, hasn't it? Interest rate volatility, hitting margins, worries about commercial real estate loans, even regulatory pressures. Now, Berkshire still holds huge stakes in other financial giants like American Express and, of course, their massive insurance operations. But a slight trim in Bank of America might just reflect a strategic decision to manage risk a bit, or maybe reallocate that capital to other areas where they see better risk-adjusted returns right now. It's definitely not a panic sale. It's more like a nuanced move that suggests active portfolio management. And potentially, yeah, a slightly more conservative outlook on parts of the financial industry, even though Bank of America itself is generally seen as a well-run, systemically important bank. It just suggests they're not afraid to reevaluate even their long-standing convictions when market dynamics change.
Right. And speaking of that broader caution and the strategic nature of their moves, this brings us to a really significant trend that's been going on for a while now, plus that fascinating and incredibly effective strategy of using confidential purchases. Okay, so we touched on this earlier, the idea of confidential purchases. This really feels like this secret sauce element in Buffett's buying strategy, doesn't it? A quiet maneuver that very few other investors could pull off so consistently. Berkshire's previous 13F, back in May, mentioned they omitted one or more holdings from their Q1 report because they were asking the SEC for confidential treatment. Explain for us again the strategic genius behind this tactic. Why do they do it?
Yeah, this is really a masterclass in deploying huge amounts of capital. It's a crucial strategic move that protects Berkshire's ability to execute these large-scale investments efficiently. As Barron's and others have reported pretty extensively, Buffett has often requested this confidential treatment precisely when Berkshire is in the middle of accumulating shares in a new investment. And the reason, like you hinted, is actually disarmingly simple but incredibly effective. It's done specifically to avoid tipping off other investors. Think about it. If the market suddenly knew Buffett was aggressively buying, say, Nucor, there would be an immediate, probably frenzied rush to buy alongside him, and that would inevitably drive the stock price up, making it much more expensive and much harder for Berkshire to build up the large, meaningful position they want at an attractive price.
Ah, okay. So basically he's buying in secret, often over several quarters, maybe even longer, and then only reveals the position later once he's already built up most or all of the stake he wants. Are there good historical examples of this? And did this latest filing shed any light on previous secret buys that we now know about?
Absolutely. It's a well-documented pattern, for sure. A very recent, very prominent example was revealed back in May 2024. Buffett's huge $7 billion investment in Chubb, the global insurer. That position only came to light after Berkshire had twice, in previous quarters, omitted purchases of Chubb stock from its 13F filings, having gotten that confidential treatment. Other classic examples people point to are his investments in Chevron back in 2020 and Verizon in 2021. Both were disclosed later after similar confidential buying periods. And this latest Q2 filing was particularly revealing because it confirmed what many analysts had suspected. Berkshire had indeed been buying D.R. Horton, Lenner, and Nucor stock before April 1st, and the SEC allowed them to keep those purchases confidential, which means their recent rise, after the disclosure. It wasn't entirely a surprise to Berkshire because they'd already been accumulating those positions quietly beforehand.
That's incredibly clever. It really highlights the strategic brilliance letting them build these huge positions without causing immediate market distortion. It speaks volumes about their very long-term, very patient approach that, frankly, few other firms could possibly replicate.
And this raises an important question looking ahead, doesn't it? Are there current undisclosed purchases still going on right now? Will we see new surprise holdings revealed in future 13F filings? It seems highly probable. This tactic allows Buffett to maintain his edge, ensuring he can deploy Berkshire's massive capital without the market interfering too much. It also helps explain why some other newly disclosed purchases, like that re-entry into United Health, were not the confidential ones. That's likely because, as we discussed, UNH shares had already hit a low in Q1 before falling further in Q2, so maybe the buying wasn't as sensitive to immediate market reaction at that exact moment. Or perhaps the volume wasn't large enough to require total secrecy. The confidential treatment seems reserved for those situations where the market reaction would significantly get in the way of their accumulation strategy, allowing them to patiently build their position without tipping their hand.
Right. And this stealth accumulation tactic, combined with the very deliberate trimming we talked about earlier, it feeds into a much larger trend. A trend that, for a company known for its aggressive opportunistic investing, might seem quite surprising. Berkshire has actually been a net seller of stocks for quite some time now.
It's a truly significant data point, and it really underscores Berkshire's broader market view right now. Despite all these fascinating new investments and increased stakes we've just gone through, the actual numbers show that Berkshire sold $3 billion more stocks than it bought between April and June. And this isn't just a one-off thing. It marks an astonishing 11th consecutive quarter that Berkshire Hathaway has been a net seller of equities. That's almost 3 full years where they've consistently sold more stock than they've bought in the public markets.
Okay, wow. So what does this prolonged net selling streak really mean? Especially when you put it next to Berkshire's absolutely staggering cash position. As of the end of June, Berkshire was sitting on a massive $344.1 billion in cash and equivalents. That is an almost unbelievable amount of capital just sitting there on the sidelines. It's nearly the size of a medium country's GDP. For a firm that's famous for its investment skill, what does this signal about Buffett's outlook on the broader market?
You've really hit on probably the most compelling takeaway from this entire filing. For a company that prides itself on deploying capital effectively, this long net selling streak, combined with that astonishing record-breaking cash pile, it sends a clear, deeply cautious signal. It fundamentally suggests they perceive a lack of compelling, large-scale opportunities in the public stock market at current valuations. Buffett and his team, they're known for their rigorous discipline, their patience, their unwavering focus on value. They're clearly just not finding enough undervalued assets in the public markets right now to put those massive cash reserves to work. Now, this immense cash position, it serves multiple strategic purposes. First, it could absolutely be preparation for a significant market downturn. It allows them to swoop in and buy assets at distressed prices if that happens. That's a classic Buffett move, right? That generated huge returns for them in past crises. Berkshire thrives when others are fearful and prices get cheap. Second, it could be strategic positioning for a truly massive future acquisition, maybe buying an entire private company outright, or even taking a huge public company private. Neither of those would show up on a 13F filing. We're talking a multi-billion, maybe even multi-hundred-billion-dollar deployment potentially. So this huge cash reserve suggests that Buffett's outlook on the broader market is one of, well, prudence and patience. It indicates a belief that current valuations across many sectors are just too high to justify large-scale buying, or maybe that the market itself faces significant uncertainties ahead. It's really a remarkable demonstration of their ability to just sit on cash for long periods when almost everyone else feels immense pressure to invest just to put capital to work. It's a testament to their long-term opportunistic approach. Discipline and patience trump the urge to constantly be doing something in the market. It's like a masterclass in waiting for the perfect pitch, as he calls it.
So he's not just buying and selling stocks. He's effectively making a very clear, though maybe subtle, statement about overall market conditions through his actions, or inaction in this case. And speaking of Buffett himself, this brings us to another huge shift happening within Berkshire Hathaway, the changing of the guard at one of the world's most iconic companies. Let's talk about the man himself for a moment, Warren Buffett. He turns 95 on August 30th. Incredible. And he announced at the annual meeting back in early May that he'll be stepping down as CEO at the end of this year, though he's staying on as chairman. Greg Abel, who's 63, is officially set to become the chief executive on January 1st, 2026. This leadership transition, it isn't just, shuffling nameplates. It is truly a monumental, historic shift for Berkshire Hathaway, a company that's been synonymous with its founder for, over half a century?
It is, absolutely. Without a doubt, it's a seismic event in the corporate world, even though, yes, it's been planned for many years. And it adds a really crucial layer of context when we're analyzing these 13F filings. It's important for listeners to remember the 13F itself doesn't explicitly say whether specific buys or sells were made by Buffett himself or by his longtime, very capable portfolio managers, Todd Combs and Ted Weschler, who manage significant chunks of the public stock portfolio. Or even if the incoming CEO, Greg Abel, had any direct input, all three likely contribute to the overall decisions. However, this Q2 13F gives us a distinct snapshot of portfolio choices made during this really critical transitional period where the market is fully aware of the huge change coming at the very top.
Okay, so if we connect this to the bigger picture, how might a corporate succession like this, even one that's been so carefully planned for years, subtly influence things, not just maybe the investment philosophy going forward, but also just the market's perception of Berkshire Hathaway itself? What could this mean for Berkshire's future investment strategies? How might they evolve under the new leadership, even with Buffett still there as chairman?
That's a profound and absolutely essential question for anyone thinking about Berkshire long term. While Buffett will remain chairman, yeah, the shift in the CEO role is undeniably significant. Greg Abel, he's been meticulously groomed for this role for years. He's renowned for his deep operational understanding of Berkshire's vast, diverse collection of businesses. Everything from railroads and energy to manufacturing and retail. Historically, Buffett has really been the primary architect, the visionary behind their big public equity bets. With Abel stepping into the CEO role, we might anticipate, a continued emphasis on large foundational businesses, perhaps with an even greater focus on operational efficiency, a pragmatic approach to acquisitions that might lean more towards industrial or infrastructure type companies. Market perception, it often ties a company's success and identity so incredibly closely to its long-standing iconic leader. So even though this transition has been carefully planned, it can naturally introduce a degree of uncertainty for some investors, people who are just so accustomed to Buffett's direct involvement at the helm. This isn't necessarily a negative thing, it's just a natural evolution for a company this size. What it might mean for future investment strategies is maybe a subtle shift towards more direct acquisitions of entire businesses, rather than just buying stocks, which kind of aligns with Abel's operational background. Investors will definitely be watching very closely for any shifts in capital allocation strategy, or even more subtly, the types of businesses they target, as the company enters this new era under Abel's leadership, even with Buffett's continued presence.
Right. And this monumental leadership change, whether it's directly related or just coincidental timing, seems to be happening alongside some interesting struggles for Berkshire Hathaway's own stock price in the near term. #tag B Berkshire stock struggles is Buffett nears CEO exit.
That's a very keen observation, yeah.
Yeah.
And it presents a really intriguing paradox. Berkshire stock, the B shares traded under BRKB, it's actually tumbled quite a bit from its record highs, which were hit around the time of the annual meeting back in early May. It notably hit a 6-month low on August 4th, right after they released their Q2 results. And right now, it's trading below both its key 50-day and 200-day moving averages. Those are often watched as indicators of short to medium-term momentum.
That is a stark contrast, isn't it? Almost ironic. While Buffett's mere stamp of approval sends other stocks soaring, Berkshire's own shares seem to be struggling, or at least treading water, maybe drifting down. So what do you attribute that to? Is it purely market sentiment around the CEO transition? Is it reflecting broader market headwinds hitting their businesses? Or maybe there are genuine concerns about the company's performance without Buffett fully running the show day to day. What forces are at play here, do you think?
Yeah, this raises an important question about how these internal corporate events, even ones with long lead times and careful planning, can still impact investor confidence and immediate market valuation. Even for a company like Berkshire, built on such long-term value and stability, it's likely a mix of several factors, probably not just one single thing. There's certainly some market sentiment related to the CEO transition. Even though it's planned and Greg Abel is highly respected, it's still a major change at the top of one of the world's most successful and unique companies. That can, almost by definition, introduce a degree of uncertainty or caution among some investors who've just known decades of Buffett's leadership. Also, broader market headwinds could definitely be playing a role. Those could be affecting some of Berkshire's underlying businesses, which, as we know, spans so many diverse sectors: insurance, energy, manufacturing, consumer goods. If certain parts of the economy are slowing down, or if there are sector-specific challenges, Berkshire's diverse portfolio will naturally reflect some of that. And finally, yes, some investors might be factoring in perceived concerns about the company's performance or future strategic direction, without Buffett's direct day-to-day oversight as CEO, even with him remaining chairman. It's really a testament to the immense, almost gravitational pull a single individual can have on a company's perception and valuation, and how challenging it is for the market to fully price in a change of that magnitude, even when it's been anticipated and managed for years. The market fundamentally dislikes uncertainty. And a leadership transition, however smooth, always carries at least some degree of that. #tag outro.
Wow. What an intricate, really illuminating journey through the mind and the recent maneuvers of a true master investor. So, to bring our deep dive to a close, we've systematically explored those intriguing new bets on healthcare, especially that bold, maybe contrarian re-entry into United Health despite all its challenges right now. We've seen the clearer macro bet on housing resilience and recovery with D.R. Horton and Lennar. We've also unpacked the careful strategic trimming of those long-held giants like Apple and Bank of America. And maybe most revealingly, we've gotten a handle on the strategic genius behind Berkshire's confidential buying tactics and, critically, that growing mountain of cash signaling a profoundly cautious yet still opportunistic stance in these, well, pretty uncertain times.
Exactly. These quarterly filings, they are so much more than just dry financial data points or a simple list of buys and sells. They really are a profound window into disciplined, long-term strategic thinking and a unique kind of adaptation in markets that are constantly changing. Understanding these patterns, how Berkshire identifies what they see as enduring value, how they meticulously manage risk, how they patiently allocate that colossal capital, it can genuinely help you refine your own thinking. You're thinking about investments, about economic trends, and about the immense value of patience and conviction. It's really about learning from arguably the absolute best in the business.
So as you reflect on this deep dive, and consider the insights from the Oracle of Omaha's latest plays, here's a final thought-provoking question for you to mull over. Given Warren Buffett's ever-increasing cash pile and the significant leadership transition that's underway at Berkshire Hathaway, what do you believe the next decade holds for this iconic conglomerate? And maybe more broadly, what does this current snapshot truly reveal about navigating periods of high uncertainty in the markets? And how might the Oracle of Omaha's final investing acts, as CEO at least, redefine or perhaps cement his unparalleled legacy in the history books of finance? Thank you so much for joining us on this deep dive. Keep exploring, keep learning, and we'll catch you on the next one.